Cypress Financial Group presents the Retirement Roundtable podcast with John Scallan. Get more at cypressfinancial.net. Now, let's get to the show.
My name is Mark Owens. John Scallan, about, 10 days into the new year? How you feeling?
Man, everything's going great for me. I mean, would you allow me to go into some really dangerous place with you? I wanted to ask you, since Ole Miss beat Georgia, how have your therapy sessions been going? Are you still in therapy or have you made it out?
John, buddy, it's been 10 days since the game.
I don't mean to laugh.
I was just getting over it. Finally put the shattered pieces of my football fandom back together, and then you got to go and bring it back up again. Too soon,
Mark,
John
listen,
the
only reason that I can even bring it up is I have had lots of time to swallow the Brian Kelly debacle. And listen, I'm just starting to feel good about Lane Kiffin. Let's hope he's the guy to bring us back to the SEC championship against those infamous Georgia Bulldogs.
Well, we can both lick our wounds together, have a cocktail, and keep watching a little college football, even though our teams are nowhere near to it. 504-732-1001. You can meet John again at cypressfinancial.net, CYPRESS, cypressfinancial.net. All right, John, just days into 2026, and between the One Big Beautiful Bill Act and ongoing Secure 2.0 provisions, there are some significant tax changes hitting about right now. So what should our listeners, the families you serve, what should they know as they're thinking about their retirement planning this year?
You know, Mark, great way to open the show. I mean, you know what's really interesting? Every January 1st brings tax changes, but, 2026 is actually a little different. I mean, we've got some real opportunities here if people know what to do and how to use these tax changes. But Mark, here's the thing. A lot of people, they have no idea what has just changed. Here's what I'm seeing. The catch-up contribution limits just went up again for people over 50 and older. If you're between 60 and 63, you can now put even more into your 401k. That is on top of the regular catch-up provisions. Now, Mark, not to go crazy with acronyms, but there's something called the SALT, S-A-L-T deduction cap.
Which is what you just poured in my Georgia Bulldogs wounds right now? Sorry. Go ahead. Sorry.
I deserve that, Mark. Thank you for that. So the SALT deduction cap, it applies to state and local taxes. That has been adjusted. And there's a new senior deduction kicking in for folks over a certain age. Here is the question. Are you positioned to actually take advantage of these changes? Or maybe you're just letting this opportunity slip by?
So if I hear you right, these aren't just minor tweaks, John. This could actually impact somebody's overall retirement strategy.
Absolutely, positively. Let me tell you what I mean. Mark, I had a couple come in last month, both 62, both still working. They've been maxing out their 401k for years. When we showed them the new catch-up limits and we calculated what the additional tax-deferred growth could mean over the next 5 years before they retire, I mean, we're talking about $40,000 to $50,000 that they could have in their retirement accounts. And Mark, this is just knowing the rules and how to take advantage of them. Mark, one more point. Here's what most people don't think about. It's not just about putting more money away. It's about the overall tax strategy. When do you contribute? When do you convert to Roth? When do you start taking these distributions? I mean, these new rules change the math on all of that.
Okay, I want to bring it back up, though. The SALT deduction, what about those changes? How does that fit in?
Mark, the SALT cap has been a big deal, especially here in Louisiana, where we've got state income taxes, property taxes adding up. Listen, if you're a high earner getting close to retirement, this cap adjustment could mean real money back in your pocket. Money you can redirect into retirement savings, money that you can pay down debt before you retire. But you have got to run the numbers. You've got to see how it affects your specific situation. Mark, here's what concerns me, though. Most people, even the ones who are smart and disciplined about money, they're doing their taxes once a year, and that's it. Tax planning, this is a completely different skill set. Remember, in retirement, tax planning means looking ahead. What moves should I make this year to set us up for the next 5 years? Should I be doing Roth conversions now while I'm still working? Should I be front-loading retirement contributions? These new laws create opportunities, but only if you're thinking strategically.
So, John, somebody's listening right now and they're thinking to themselves, I have no idea if these changes could even apply to me. What would you tell them?
You know what I would tell them is simply this. Most people, they just don't know. They don't know where they actually stand. They don't know if they're on track for retirement, what their retirement will actually cost them in terms of income needs, or what implications they may be facing from a tax perspective. Give us a call, 504-732-1001. You can book a complimentary, friendly, no-pressure consultation. Or if you're not quite ready to take that step, just ask for your Retirement Ready report. Our team will walk you through a few quick questions. Takes about 10 to 15 minutes, and within 24 to 48 hours, you're going to get a high-level, personalized report showing exactly where you are. Either way, no cost, no obligation, just clarity. Because of these tax changes, they really matter, but only if you know how to use them for your specific situation.
And John, this time of the year, boy, I'm starting to get some of those bills from the holidays. Woo, John, I got a little excited buying the presents this year.
Christmas, and then there's the tax bill that's rolling up.
Oh, and then did I tell you that I had a pipe burst in my basement too?
Oh, joy.
Yeah,
joy coming home to wet floors. That's always a real
holiday.
disaster.
Just add that on top of everything. John, I want to talk about debt because I feel like I'm just getting piled up in debt right now. J.L. Collins wrote The Simple Path to Wealth, and he's genuinely not a fan of debt. He says it interferes with the retirement planning, but he told Morningstar there's actually an instance where he'd pause before telling somebody to pay it off.
A good example of that is suppose you have a mortgage from a few years ago that's 2, 3, even 4%. Well, in that case, I'd say, okay, if you're carrying debt that's less than 4% interest, maybe it's not such a bad idea to keep that debt and invest the excess money instead. If you're somewhere between 4 and, in my mind, maybe 6%, anything above 6%, absolutely, job one, blow off the debt before you do anything else.
All right, John Scallan, I feel like I need to give my deep voice after hearing that right there. Do you agree?
You know, Mark, I really appreciate Collins's work and his deep voice. You know, Collins, he makes people think about money differently, and his math is sound on the interest rate question. Here's what I've learned after many, many years of doing the math. The interest rate tells you a lot, but it's not the only factor when you're approaching retirement. Mark, literally, we had a couple come in. They heard this show, came to the office, both in their mid-60s, looking to retire in the next year or two. Here's what made their situation interesting. They had close to $2.5 million in investment accounts, doing really well. But they also had 2 mortgages, one on their primary home, sitting at a great 2.5%. Another was a second at 6.5%.
Oh, so a good rate and a bad rate.
You know, Mark, exactly. The husband wasn't too worried about carrying this debt with him. They've got $2.5 million in assets. So the mortgage didn't seem like a big concern. But here's what happened when we looked at the math. That 6.5% on a $250,000 second mortgage. I mean, simple mathematics, it's costing them $16,250 a year in interest alone. That's money, in our opinion, that's just evaporating. It's not building equity. It's not growing wealth, just gone. Now, you've got the $2.5 million in investments, right? So years of those investments do great. Some years really work. Other years, not so good. Markets could drop over 20% like we saw this April, like we saw in 2022. But that 6.5%, it's hitting you every single month, whether markets are up, down, or sideways.
So if I'm hearing you right, John Scallan, even with substantial assets, that high interest debt could still be a big problem.
Oh, absolutely. I mean, here's the question that I would ask. Would you borrow money at 6.5% to put into the stock market? Of course not. But that's essentially what's happening when you're carrying 6.5% debt while hoping your investments earn more than that. And think about this. When you retire in a year or two, you're pulling over $2,100 a month from your portfolio just to make this payment. If markets really pull back or crash right after you retire, you're selling shares at a loss to pay debt. That is not a position you want to be in. So we made it clear. Priority number one, knocking down that 6.5% mortgage. That interest rate working against you is difficult, really difficult. It's a drain on your wealth.
I understand with the 6.5% mortgage, but John, what about that mortgage that's at 2.5%?
Yeah, that's a different story. In my mind, that's cheap debt. I mean, I had one client say, it's actually free money. Well, I said, it's close. I wouldn't call it free, but certainly a great rate. Collins is right on that one. If you've got a 2.5% mortgage and you're comfortable with the payment, I really don't think that's priority. No rush. Keep the liquidity. Keep the investments working. But anything over 6%, man, you've got to deal with that. I mean, the math does not work in your favor. This couple had the resources to eliminate the high interest debt using some of the money in their taxable account. This still left them with over $2 million working for them, but freeing up that $2,100 a month, that $25,000 per year. That's huge going into retirement. Now, Mark, here's the broader question that I like to ask everyone. When you imagine yourself retired, how does this debt affect your cash flow? Sometimes the answer is, hey, the rate's so low, I don't even think about it. Great, keep it. We can work through it over the first portion of your retirement. Other times I have clients tell us, look, I cannot relax knowing I owe this money or that this monthly payment is eating up too much of my retirement income. Then we need to go in and come up with a plan and deal with it.
What would you tell somebody that's wrestling with this type of decision, John?
Here's what I would suggest. Pick up the phone, 504-732-1001. Book a complimentary consultation. We'll sit down. We will look at the whole debt picture. We will run multiple scenarios. Or, again, as I've said earlier, if you're not quite ready for that, let's do the Retirement Ready Report. Our team will walk you through a few quick questions. Takes 10 to 15 minutes, and we'll get this personalized report showing you where you stand. Either way, no cost, no obligation, because this debt question, there's no one-size-fits-all answer. Your situation, your specific situation is the only one that matters.
And we have a live representative standing by right now to answer your questions. Again, that number is 504-732-1001. or you can always get more at cypressfinancial.net. And John, the latest labor statistic data just came out, and it shows what the average retiree actually spends. You want to take a guess at it?
Ooh, tell me. You're going to get me on this one, so I'm not going to get myself out on a limb too far. Go ahead.
It's shocking to me, but again, I'm on the outside looking in. Just over $4,600 a month. The breakdown goes, housing takes over $21,000 annually. Transportation, $9,000, healthcare over $8,000, food over $7,700. These are the biggest categories that eat up most of the budget. Again, we're talking over $4,600 a month. That sound about right?
Yeah, that sounds about right. I mean, Mark, you know what's fascinating about that? So many people, they don't live on a budget. I mean, we literally see it every single week. They just spend, and I'm not talking irresponsibly spend. They're just in this routine. You know, we sit down with someone who's getting ready to retire and we ask, how much do you actually spend each month? The answer many times is, I just don't know. We're just living. Yeah. So, Mark, let me tell you about a hypothetical situation. Let's call this couple Richard and Debbie, both 64, came in last quarter of 2025. Richard said, John, we're thinking about retiring next year. We've got $680,000 saved. You know, he looked across the table and he said, is that enough? I said, I really don't know. I mean, how much do you need? He looked across the table at Debbie, and Debbie looked at him, and, you know, nobody had an answer. Mark, this is not that uncommon.
So how do you handle a conversation like that?
You know, we call it a lifestyle expense audit, right? I had them go back through 6 months of bank statements, credit cards, everything, power bills, grocery, add up what they actually spend, not what they think they spend, what they actually spend. Groceries, restaurants, utilities, insurance, gas, home repairs. I mean, the whole enchilada. 2 weeks later, they came back in. Richard had this tight spreadsheet. And I mean, he actually looked a little shell-shocked. He said, John, we're spending $6,100 per month. He said, I had no idea. Mm-hmm. And you know, there's nothing wrong with that, but you've got to plan for it. You can't retire on $4,600 a month if you're actually living on over $6,000. The math just does not work. So we broke it down. Essential expenses, mortgage, property tax, insurance, utilities, groceries, healthcare. That came to just over $4,000 a month, right in that national average range. But then we got into discretionary, restaurants, travel, entertainment, gifts, another $1,900. Now we had something to work with.
So how did that change the overall plan?
In this hypothetical situation, let's just say Social Security was going to give them about $4,800 per month combined. So on the essentials, covered. But what about that discretionary spending? That's another $23,000 a year that they need. What we did is we structured part of their retirement savings to create additional reliable income, over $1,500 a month, to cover most of that gap. The rest comes from systematic withdrawals from their growth investments. I mean, Mark, here's what gave them the confidence. We showed them the plan year by year. What does my income look like? Where does it come from? What happens if we live to 85 or 90 or 95? What happens if markets crash? What happens if one of them passes away early? They could see it, not hope, not guesswork, see it.
Okay, so what about the people, John, who are already retired, but now they're realizing they're spending way more than they thought?
Yeah, this is common as well. It happens all the time. Someone retires, 6 months later, they're thinking, wait a minute, where's all the money going? I mean, Mark, here's the reality. Retirement doesn't mean you spend less automatically. First few years, we call this the go-go years. You're healthy, you're vibrant, you want to travel. In this first stage, sometimes you spend even more because you have more time to travel, projects, enjoying your life. This is when a plan matters more than ever. And Mark, here's what I see that concerns me. So many times people come in with a pile of stuff, we call it, a 401k here, IRA there, some brokerage accounts, Social Security. But here's the thing, it's not integrated. There's no plan for how do I turn this into $6,100 a month that I actually need. It's just hope. Hope the markets cooperate, hope it lasts, hope nothing goes wrong. Mark, that is not a plan.
So, John, if there's an answer, what would that be?
Well, I would say the answer is you've got to know two things. First, what does your life actually cost? Not the national average, your life. Second, how do you engineer your assets to reliably produce that income for 3, maybe even 4 decades? That is what we do at Cypress Financial. We take that pile of stuff, we turn it into a strategic income plan, conservative money covering your essentials, growth money fighting inflation, tax efficient withdrawals. We can calculate all of this. So many professionals in our industry just don't do the math to really split hairs to get to what's going to work for your specific situation.
John, there's somebody listening right now, and they're thinking to themselves, I have no idea what my retirement will cost me. What would you tell them?
Give us a call, 504-732-1001. We'll dig into what your retirement actually costs, where the money comes from, how it all fits together. Or again, if you're not quite ready, ask for your retirement ready report. Our team will ask you a few quick questions, and within 24 to 48 hours, you will have that personalized report showing where you stand from a high level. One of the big questions it answers is what does your retirement actually cost? Not some national average, but your life, because you can have only confidence if you have the data. The numbers never lie. Clarity on what you're actually dealing with.
And again, that number is 504-732-1001. We have a representative from Cypress Financial standing by right now to talk to you. Get a couple of quick pieces of information to help you build your retirement-ready report. Or if you just want to sit down and ask John Scallan, where am I? How am I looking for my financial future as I head towards retirement? Again, that initial consultation, no cost, no obligation. 504-732-1001. Real quick, John Scallan, not one, but 2 locations of Cypress Financial. Where can we find you?
Absolutely. 3421 Causeway Boulevard in the heart of Metairie, very close to Lakeside Mall on the North Shore, Florida Street in Mandeville. You can meet with us at either of our locations. We also, we'll do a road trip. If you're in a jam and you are not in the New Orleans metro area, we'll come on out, spend some time with you at your home or business, and just make sure that you have the tools to take you into this next chapter of your life with confidence.
Investment advisory services offered through Cypress Financial Group, a registered investment advisor firm. Registration is not an endorsement of the firm by securities regulators. By contacting us, you may be provided with information about insurance products, including annuities offered through Cypress Financial Group, John Scallan, Louisiana Insurance License Number 1064997. The firms are separate entities. Annuity guarantees rely on the financial strength and claims paying ability of the issuing insurance company and are not offered by Cypress Financial Group. Read your contract for restrictions, limitations, or penalties.